Hello, everyone, and welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. Just a little bit earlier today, we were behind that wall in the brand new StockCharts TV studio, which we unveiled at ChartCon 2022 about a month ago. We are finishing up all the preparations for a full running studio and are excited by the end of this year, fingers crossed, everything will be up and running in its all final format for now. And we'll hope in the new year to start unveiling some new programming and new opportunities using that fantastic new studio. Just to give you a heads up on the schedule coming up. Next week, we have Larry Tantarelli of Blue Chip Daily joining us on Tuesday the 15th. On Wednesday the 16th, Ryan Dietrich, Chief Strategist at Carson Group. On Thursday the 17th, Julius de Kempener, founder of RRG Research, creator of the RRG methodology, and longtime contributor to StockCharts and StockCharts TV. Let's continue on our show today with this discussion of markets. And we're going to talk about the overall movement today. A fascinating day, to be honest with you. And what's so interesting to me is that the markets were not too long ago making a new low, right? Amazon, Microsoft, others making a new 52-week low. Not Microsoft, Amazon, Tesla making a new 52-week low yesterday. So all of a sudden you have these big gains, and I'm seeing notes about Amazon up on whatever news. The reality is this is one of those everything rallies. Everything's up on a day like today. It's all about the inflation number this morning. Investors have been looking for color from the Fed, color from economic data to just try to get a sense of what the trajectory is with future Fed rate hikes and Fed policy changes. Certainly, the market is interpreting the downtick in the pace of inflation that we saw this morning, suggesting that there's a light at the end of the tunnel, suggesting the Fed can lighten up on their strategy. While I 100% understand the reason for today's rally, I don't think with Amazon coming off of 52-week lows yesterday, you can consider this an all-clear rally. This is certainly a meaningful bounce. You could see there being further upside as a lot of stocks certainly have gone from negative to neutral and from neutral to very positive. That's undeniably true. The question is, how far do we go, right? I mean, I don't think you could assume if the Fed is going to continue to raise rates over the next 3 to 6 months, that would mean growth stocks should be rallying from here on out, right? I mean, I would argue that rates are still going to be pretty high, probably down today, but overall the trend is still with higher rates. And I don't think we're done. I don't think we've seen a high in the 10-year just yet, which is an unpopular thought on a day like today when the S&P is up 5.5%. But that's where I am at, taking a step back from the monitors. Let's look at the charts. It's not about me and my perception. It's about the charts, and let's focus on the evidence the markets provide back to us. Here are the details. The S&P closing just above 3950. That's up 5.5%. From yesterday's close. The NASDAQ up 7.4%, potentially its biggest day in history, certainly one of them, and the biggest up day since 2020, I would say for sure. I don't have that data in front of me, but it's been a long time since we've seen an up move to this degree. Mid caps and small caps both up just under 6%, and the VIX pulling back to just above 23, around 2350. This next page shows you what you need to know about why and how equities can move higher. Risk assets can move higher in this environment if rates come off and if the dollar weakens. And that is exactly what we saw today. The 10-year yield finished yesterday around 415. It finished the day today around 383. That is a big haircut in rates, down 32 basis points just from yesterday. Bond prices obviously moving higher. And we talked about that traditional relationship. Martin Pring wrote a great article about that earlier this year about bonds, stocks, and commodities, and really looking for leadership from the bond markets. You saw that today. You also saw the dollar index move down, so the UUP down over 2%, and that stronger dollar environment has been sort of the wrecking ball for risk assets. Risk assets can move higher if the dollar weakens, and that is certainly a part of this day, a raging up day for risk assets. Commodities pushing ever upward to the upside here, with gold up 3%, silver up 3%. Crude oil prices probably the least attractive, although corn was actually down today. But most of the commodity ETFs that we track all positive. The precious metals outperformed the energy areas of the market today, and the energy sector is still up over 2%, but the worst performers of the day sector-wise. Don't get too excited by the fact that Bitcoin is up 13% today and Ether is up 20% today. That's a big number. That's totally fair, but just keep this in mind. Today's rally with Bitcoin getting up to around 18,000 still doesn't even bring us to the prior day's high. This is how volatile these markets have been. And this is just after cryptocurrencies obviously cratering over the last couple of days. So this is one of those things about a market like this, right? When you have a market that sells off so significantly, you're going to have incredibly powerful reactions back to the upside. Just yesterday, we're talking about this narrative where cryptocurrency is so weak, obviously with Binance and FTX and all of those, such weak, headwinds, the strong headwinds, really, I guess is what you would say, to cryptocurrencies going higher. And the last week has been, one of the worst weeks in record for Bitcoin. All of a sudden today, you bounce quite a bit higher from yesterday's low. This is actually what's called a bullish harami pattern, which is a big down day, a big up day, where day one's body engulfs day two. It's sort of the flip around version of a bullish engulfing pattern, which is day two has a much bigger candle. If day two has a smaller candle, it's actually called a bullish harami pattern. And it is a short-term bullish pattern. So don't get me wrong, coming out of an oversold condition, bullish candle pattern, it's suggesting the next 1 to 3 bars are higher. And I would say coming out of this sort of level on the major averages, certainly there's a lot of strength. Certainly there's a lot of excitement. I don't know the details of the market structure, but I would say probably fair to assume there's a healthy amount of short covering that had to occur, margin calls, right, as the S&P, the NASDAQ. S&P bounces off the 3750, gets all the way to 3950 in one session. You're going to have people trapped on the wrong side of that trade coming out of the open and have to cover those shorts. This was a shaded area that I highlighted in an interview yesterday. I don't know if I shared this on the show or not. It's kind of blurring a little bit for me, but I could sort of identify this 4,000 to 4080 range. That comprises a couple key things. That's the 61.8% retracement of the August peak to the October low. And then the 200-day moving average currently around 40.80. So this is going to get lower every day as it catches up with the price action that's well below the 200-day. So could be an ideal sort of place for this market to rally toward. That would certainly be a place to look at. If you look at the strongest bear market rallies that we've seen here in March and here in July, you usually made it back to the previous swing high. And I would say that probably means upside, I would say the most bullish scenario I could see is we get up to around 43.25, which would take us above all of that resistance and get to sort of that last level, which is the August peak. This is the conversation we had back here where we talked about, the price getting to that last level of resistance. It failed. Here we talked about the market rallying, get to its final level of resistance. It certainly failed. So that would be sort of the eventual peak or the ultimate peak. I don't see a scenario where risk assets are able to appreciate much above there before people are really excited to take profits. Worth noting, as of today's close, the RSI pushing above 60 for the S&P 500. That's actually the highest level that we've seen since mid-August, when we really started in July, when we sort of had this leg higher going into the previous highs. RSI above 60 is more characteristic of a bull market phase, and that might tell you, I think this might be enough to suggest further upside from here. After a day like today, it's all about what happens tomorrow, right? What's that follow through? Do we retrace what we did today or anything else? Worth noting, my market trend model, by the way, just to bring this up, I don't update this until Friday's close. So unless we have a big sell-off on Friday, and again, depending on what happens, most likely the short-term model would remain bullish. It was actually turning bearish here earlier in the week. Given today's rally, and again, barring some, if we give it all back tomorrow, which is certainly possible, short-term model back positive or remains positive for me. Medium-term model might actually turn positive if there's enough of a rally, which would be the first time since August that indicator would be positive as well. Just to wrap up our market recap, just want to hit on sectors. The tech sector, the XLK up 8%, REITs up over 7%, along with consumer discretionary. Communication services, one of the worst sectors in 2022, up 6%. The laggards were energy, consumer staples, and healthcare, again, all up 2 to 2.5%. So again, strong day across the board for a lot of charts out there. Last thing I just want to leave you with here before we take a break, I was looking at we were testing the studio behind me, as I mentioned, just going through some sample charts. And one of the charts we brought up was the S&P 500 with the PPO, which again is similar to the MACD. It's a simple trend following device. And I was looking at this and just thinking, wow, For the last 6 months, if you just had the chart of the S&P and the MACD or the PPO, you got a buy signal there, third week in June, got a sell signal there, the third week in August, got a buy signal here, the first week in October. You didn't pick the ultimate tops and bottoms, but you did pretty well, sort of picking this medium-term trend, right, of looking 1 to 3 months out. It's tracked beautifully well using an indicator like this. It's a great reminder that sometimes just the simple approaches often can keep you on the right side of things. Let's take a quick commercial break. We'll be back doing a deep dive into the financial sector. We'll see you in a minute. Hey guys, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close so much. A couple quick announcements before we go to my next segment, the sector deep dive. First off, we welcome your questions. A couple ways you can get your questions to us for our mailbag segment coming up on Friday's show. Via email is the best, thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also go to StockChartsTV.com. That is our on-demand platform. There is so much great content every trading day featured on our on-demand platform. Fantastic guest contributors, all of our regular scheduled shows, of course, the Final Bar with all of our previous episodes and interviews. All are available on demand at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Continuing on the show with our next segment, the sector deep dive. What we like to do occasionally is dig into a particular sector. This really mirrors what my experience on the institutional buy side, where we would really try to think about sectors individually and focus on the mechanics of the sector, what drove the stocks higher or lower. Thinking about themes, thematic plays within the sector, group and industry strategies, and just trying to understand a lot more deeply what is happening. We only have a few minutes to kind of talk about the financial sector, but that's where I'd like to go. Now, a couple different ways you can think about a sector deep dive if you're trying to do this on your own, which I would encourage you to do. Here's what I would probably do, and again, if we had time, we would go through this in much more detail. First off, I would use the RRG and look at where that sector is relative to the others. We're talking about financials, which is this one right here. If you select this sector on its own, you can sort of separate that and focus on that particular sector. Think about where it is relative to all the other sectors. We're focusing on financials because after energy, which has been a strong positive outlier, it's a couple other sectors that have emerged in a position of strength using weekly data: financials, healthcare, and industrials. When I was scanning for new ideas for my market misbehavior premium members earlier today, I couldn't help but notice a lot of strength in the financial sector, a lot of individual names that had not come up on my radar for quite some time, all started to come up on those screens. Second thing I would do is go actually to the chart of the financial sector. I like to do it here because I have these sector charts already set up. So this is a chart of the XLF. This is another reason why I wanted to talk about the sector today. This pink horizontal line is sort of what I'd call a pivot point, or sort of a point of polarity, a price level which we have rotated around, which has meaning for this chart for quite some time. Look at the last 2 years. Look how often this sort of 35-50-ish range has come into play. It's often been a low when we've been above that level. It's often been a high when we've been below that level. We just reached that level again today. What's interesting about this is if you look at the topping pattern in 2021 and 2022, it's about a 14% drop from the peak to the neckline of this basing pattern. Once we broke down through that level there in April and May, measure a similar move down, it gives you another 14% haircut to around 30.50, and that's pretty much exactly where we bottomed out over the summer, and then again about 6 to 8 weeks ago. From there, we've rotated right back to that midpoint. I see a lot to like as the sector has now gapped above its 200-day moving average. If it can get above its high from August, which it's right at the point of doing, there could be much further upside in this space. The third thing I would do if I'm breaking down this sector as part of a deep dive is to go to the charts and tools button at the top left of our website and go to industry summary. I like to switch to table view and then go down here to the financial sector, because you can sort the sector based on their scooter ranking. So we take all 106 Dow industry groups, we rank them based on their trend characteristics on 3 different time frames, and we order them in terms of strength. The higher the number, and it's a percentile ranking, basically 0 to 99, the higher that number, the stronger the trend relative to all the other groups. You can see the asset managers group, 94th percentile relative to all the other groups out there. If you click on that sector, you can see all of the stocks that comprise that sector. You can sort it by market cap, which is often what I like to do. Just focus on some of the larger names and see what they're sort of doing. Now, a lot of these you can see are coming from pretty beaten down levels, and BlackRock may be a good example of that sort of rotation, right? Look at the chart of BLK. Found a low in May around 575, undercut that level in September, made a new 52-week low, and then you had this brilliant sort of bullish engulfing pattern there in early October. From there, we've retraced 100% of the way back to $750, which is the August high. So just how I talked about the XLF trying to get above its August high, some of these names are actually already starting to do that. Now, this is a name up 13.5% today. The sector as a whole did very, very well. Some individual names actually drove to the upside in a brilliant way. Just the last minute we have left, I want to highlight just a couple different types of names that I think are worth focusing on. First, we have sort of the asset manager group. That's the group that I was just highlighting there. Jefferies is a brilliant example of, I think, the strength that you see in that group. Look at the low in June. So far, that has been the low for the year. Look at this rotation, I would argue, from a distribution phase from October to June to an accumulation phase. Overall, the trend going higher. It went from being below 2 downward sloping moving averages here in May and June to now being above 2 upward sloping moving averages here in November. Made a higher low here in October and now in early November around 33, just broke above 35, making it a new swing high, which means if you go long on a day like this, I would immediately be thinking of natural stops. And when I think of a natural stop, just look on the chart at what level do you see a level sticking out, a level of potential support? $33 certainly seems like a reasonable point. The 50-day moving average, not too far below, around 32.15, 32.20. Overall, this is a stock making a new 3-month plus high, making new relative highs. Charts like that, I would probably never feel bad about owning. Now, you also have some regional banks like OZK, is Bank of the Ozarks, if I remember right. I think the official name is Bank OZK now. But if you look, you can see a similar sort of rotation from distribution phase in the first half of the year to accumulation phase in the second half of the year. Look at this sort of basing pattern, this rectangle pattern of a consistent high and a consistent low, breaking out of that pattern, breaking above $44 a share and now pushing through to the upside. Up until today, it was still sort of trying to break out. Today sort of completes that rotation, and this pattern of higher lows is, I would argue, what's most encouraging about that. So that's a totally different group. Then finally, you have insurance stocks, which are very, very different. And within that group, you have charts like MetLife making a new 52-week closing high today. Now only up 2.7%, which means it underperformed the S&P today. But overall, in terms of price structure, I see a higher low in September, and I see it breaking to multi-year highs today. If you go through the financial sector, use our scanning engine and look for that particular sector for stocks making new swing highs, stocks with bullish PPO signals or anything like that, you will find some charts like this with clear rotations from a position of weakness to a position of strength. I think the financial sector, which certainly would do well in a rising rate environment, overall rates are still most likely going to be moving higher, even though today it certainly did not. And if that's your story, if that's your thesis, then the financial sector may deserve a second look. Let's continue on our show with our next segment, Getting Sentimental. What we like to do every Thursday is check in on sentiment data. I think of it in 3 different areas. We have volatility, we have survey data, and we have options data. And let's look at each one of those one at a time. So the VIX had been sort of holding above 25 until today. The big move higher in the major averages actually pushed the volatility down. And that's not true. It's not the upward move pushed volatility down. It's the market moved higher, and the volatility readings from the options market, which is where the VIX is derived, actually went down. Overall, there tends to be an inverse relationship between the S&P and the VIX. And you can see that in general. Periods where stocks are going lower, the VIX in general is trending higher. Periods where the S&P is trending higher, the VIX in general turns lower. In 2022, you can see this general range from around 20 on the lower end and 30 to 35 on the upper end. If you simply look at when we're down to 20, when we're above 30, overall, you have the general sense of where those market tops and bottoms have basically been. Looking back here, you can see how clearly the VIX got above 30. It first happened in late September, made a new high in October as the S&P undercut its September low. From there, though, we've gone slowly and steadily downwards. I'm noticing how we broke below the 50-day moving average about 2 weeks ago. You can see how the S&P obviously in a pretty good uptrend with today's today's move really sort of confirming that short-term upward bias at the very least. So what do you do in this environment? If and when we continue to go higher, which it seems to be, at least in the short term, the nature of what we're doing, I will be watching this chart to see when the VIX gets down to 20. You will hear me make a great deal of noise about that fact, because that has been a very reliable signal of market tops in 2022. The AAII survey, a bit of a change from last week. Last week, we had about 30% bulls. This week, it's down to around 25%. Bears down to, or up, I guess, from last week to around 47%. Now, again, the survey was not completed today. The information is actually gathered, if I remember right, yesterday, and then produced or reported today on Thursday midday, which means it didn't include anyone's reaction to the raging update today. I bet if they ask these same questions today, you might get a very different reading of the AAII survey. That is the nature of survey data. It's a pinpoint in time, and it's capturing sentiment at that moment. So you have the S&P obviously moving higher into the close today in a pretty big way, but overall the sentiment took quite a bit of a more negative tilt. Last week, we were almost even between bulls and bears. This week, bears once again taking over, about a 22% overweight of bears over bulls. The name exposure index tracks money managers and where they're positioned. Again, I would say it's not really reacting yet to today's move. This is more checking the overall positioning through into today's session, not coming out of today's session. 53% weighting in equities. So that's a bunch of money managers. What's your allocation to equities? 53% is well below the sort of average reading, which is around 70% for this indicator. So money managers in this survey still underweight stocks. And again, it's worth remembering, right? If you look at the weekly chart of the S&P, this crazy big day, one of the biggest gains ever, is still not really getting us, in and out of a downtrend, right? I mean, if you take a step back, we're still making lower highs and lower lows. And I think that's worth remembering in this sort of move. I think the S&P, the NASDAQ have a lot to prove before the medium-term and long-term picture starts to improve. What we're seeing now is certainly strength in the short term, undeniably so, but it's still short-term data in my opinion. The RIDEX flows show where investors are rotating within the RIDEX family of funds, still fairly defensive at some of the more defensive levels we've seen over the last 5 years or so. And again, I would expect both of these, I'm assuming we continue a bit of an uptrend going into next week, you would certainly see both of these numbers change, right? You would see the RIDEX investors getting way more bulled up. You would see the name exposure index certainly get more bullish as investors react to the rally that we've seen this week. Just to finish off our discussion of sentiment, the put-call ratio. So this is looking at puts versus calls and positioning data in the options market. There's the total put-call ratio that we're looking at here, which includes index options. We also have an equity-only put-call ratio that's reported from the CBOE and is again takes the indexes out of the equation. I've heard many brilliant investors argue that one or either is better than the other. I tend to look at both because I found that at times one of them is just tracks better a particular trend, and I think that's more just the nuances, the subtle nuances, the difference from one trend to the next. Right now, if you look at the put-call ratio, and the pink is actually a moving average, a 5-day moving average of the raw data. The raw data series is incredibly noisy because it's reported every day. So I smooth it out with a 5-day, basically looking at a rolling weekly number is essentially what you can do with that. And it just takes the noise out of the way. If you look at that 5-day average, we're literally at the midpoint of what we've been in 2022. I would say just visually, that's sort of what it looks like. So with this rally here, the put-call ratio has increased sort of to a neutral reading, right? And so I think if and when we would continue to see a rally here in stocks, you most likely see the put-call ratio go down. You're actually seeing the put-call ratio go up over the last couple of weeks, which usually moves inversely to stocks. I usually see the put-call ratio go higher when the market's going lower because that indicates investors are getting more bearishly positioned. When the market rallies, you usually see the put-call ratio go down. So it's become almost more positively correlated in the last couple of weeks, which is an interesting data point I'll have to think a little bit more about to reflect on. But this little down tick is just today's reaction overall. And actually, that's not true. This is actually not updated. This is through through Wednesday's close. I was going to say it's probably going to come down quite a bit when we or spike quite a bit, given the move today that we saw in stocks. Overall, if you look at the equity only put call ratio, you can see some of the highest readings on record. And again, put call ratio tends to be pretty high at market bottoms, tends to be pretty low at market tops. Look how overall the trend in the put call ratio has been much more positive in 2022. We need to wrap the show, folks, and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I'm a big fan of point and figure charts. It is earlier in my career, I used them every day. I used them often as I was looking at individual stocks. I've gotten away from that, but a lot of my conversations with people like Roman Bogomazov, Bruce Frazier, sort of the other white coffeeans that we have through the show, we often talk about point and figure charts, and I've often jotted down after those shows, must look at more point and figure charts. I do look at the Bullish percent indexes very often, which are basically breadth indicators that are constructed based on point and figure charts. This is looking at all 500 point and figure charts in the S&P. What percent of them are in a bullish signal most recently? As of today's rally, we went from the low 60s to above 70%. And I would argue that's actually very important. If you look back in 2022, this indicator has gone above 70% 3 times, once in January, once in late March, once in late July. All 3 of those times, we came out of that 70% range. We came back below there. And all 3 of those were essentially the 3 most significant tops in 2022. So as this market would continue higher, which I think probably makes sense given the strength that we saw today, that's usually not a one-day move. Usually see some further upside after a move like this. This is a chart I would absolutely be watching to see when we go back below 70%. That might be a great opportunity to take risk off and take profits on the short-term rally. Chart number 2, Albemarle, ALB. In the materials sector, I found a number of new swing highs, SBSW, FCX, gold names, which we'll talk about here in a minute. But I want to just focus on Albemarle. This is a name we've talked about before because at times it's been one of the better names. And a nice strong move in relative strength. As the market was deteriorating there in the third quarter, look how ALB is making a new 52-week high. Impressive divergence from the overall market. Today, making another new 52-week high, making a new relative high versus the S&P 500. This is as the markets overall were doing well. This is in the top sort of 1% of large cap stocks using our scooter rankings. Charts like ALB making new highs, pretty constructive. I would never feel bad about owning names like that in a portfolio. Finally, it's been a long time since we featured a gold stock as one of our 3 and 3, but I'm doing it. NEM, Newmont, making a new swing high, not a new 52-week high. We have a long way to go for that, but breaking above resistance around 45. A lot of gold stocks, even FCX, Freeport-McMoRan on the new 3-month highs list. Worth noting, could be the beginning of another commodity rally with the dollar weakening. Folks, that's a wrap for our show. I want to thank you so much for supporting StockCharts TV and watching our content. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.